Hello audience and friends, welcome to my video about price behavior teaching video series number 11. In the last video, we looked at trading bands, what makes them tick, and how the K-line chart behaves. Today we will continue to learn how to trade the range form. This course mainly focuses on the signals of failure to break the range. This is the successful break of the range that I trade a lot. I will talk about later. I will not talk about the high altitude and low altitude of the range, because I do not look at the signal K-line directly pre-order to enter the trade, and the trading logic of high altitude and low altitude within the range is very simple. As soon as you see a clear interval forming, you put up a single order and the upper level is much lower, and as long as the interval lasts you can keep making money. The mathematical advantage of this trading strategy is that, as I've been talking about, market movements have an inertial tendency to stay where they are, so the probability of a false breakout is greater than the probability of a true breakout. So it's an advantage to do interrange trading even if you don't need the validation of the signal K-line. Personally, I like to wait for the validation of the signal K-line to enter the market because I feel very insecure in the trading process by directly placing the order on the left side. Of course, there is no right or wrong way to enter the market, and choose the way that is comfortable for you. Before I talk about the specific trading patterns, I should mention something else. I talked to my friends in the group and observed the comments on the video. I found that many novice traders always looked for the signal K-line to enter the market in the wrong state. So for example, this is a 30-minute chart of gold and there's a significant band resistance in front of it, which is the previous band high in this market state and in this cycle. We're now 150 plus K lines away from the previous band, and you can see, if you go down at this distance to find the signal K line entry, for example, single K line reversal, double K line reversal, the success rate of the second breakthrough is not very high. In fact, here you can see that there is a second breakthrough short structure in this box. The K-line is very small and I don't know if I can see the video clearly. We can see that the short signal was rejected by the market, and the reason why the signal K-line doesn't work in this market state is quite simple, and the whole structure in this graph is the distance between the points in the front band. This whole structure has over 150 K wires, and your entry signal K wire is usually made up of 1 or 2 K wires, at most 5 or 6 K wires, like the second break short structure here it might be 4 or 5. You have a signal of a few K wires versus a structure of 100 or 200 K wires or even more, and some people use 300 or 400 of your signal K wires, which of course is very weak, and your signal K wires are only a few K wires, so it doesn't work very well. Now, let's switch to the 1 hour period that we saw before, just one period, and we can see that in this period we are only about 80 K lines away from the previous band point. 80 K lines is still a little bit too much, but we can already see that the utility of the signal K lines is clearly increasing. The second break here is the short structure, and then I didn't cut it out and then it fell. Again, the same thing with a pullback. We have in this 1 hour period chart, at the moving average we have a simple high 2 pullback into the field, and the K-line is right here. And the high 2 pullback here is the Aubuchon system. I won't talk about it much, and I don't use it much as long as you know it's an entry signal, the K-line. This with the signal K-line after the establishment of the price quickly rose. Notice I'm marking the signal K-line, not the entrance K-line. Let's switch to the 15-minute chart again, the same chart but with one market cycle, and on the 1 hour chart you can see a simple pullback at the moving average and a very clear bullish trend, and now on the 15-minute chart, the market has made a very complicated adjustment. At this point it's very difficult to find the signal K-line entry. You don't see very good credit K-line, but you are here to trade. This bull flag shape is very simple. In a brief summary of the composition of the small number of K lines in the form of the structure of how much is not clear number is more judging by experience to say that it is best not to more than 100 K lines. In the composition of the small number of K lines in the form of the structure you can find signals K line entry transactions, such as looking for a single K line reversal or double K line reversal or second breakthrough is okay, but if you have a large number of K lines in a form structure, Like a form structure or a section or a bull flag that's made up of hundreds of Ks. In that case it's best to trade in an entry form like a double top-bottom head shoulder top-bottom wedge top-bottom breakthrough like that. If you insist on serious learning, friends at this time should think of the current level of the second breakthrough form I talked about before as the double top and bottom form on the small cycle. So what I said above has no meaning for the experienced veteran. It's basically a novice, and he has to understand the difference and not try to get a K line in a big configuration, because I've seen a lot of people do this. There are 100 or 200 K lines in front of the band and he goes and finds a single K line and reverses and enters, which is obviously a very low success rate. Let me show you another example to give you a sense of the difference between the same shape and the same size and the same time period. So this is a 4-hour graph and this interval is about 80 K lines. In this case we can see that the signal inside the K line is still useful, for example, a single K line reversal or a proof of support like this, or there is a more complicated K line pattern, let's not say it, but we can see that the K line is useful here. If we switch the time period to 1 hour, we can see that there are a lot of K lines, and now the signal K line in the diagram it's not very useful and it's prone to failure signal K lines. So here, for example, you can't really see it in the middle of the video, it's very small, but in this market state you can see the obvious structural patterns, like here's the speed 3 push, here's the little box, and so on. Let's switch back to the day line, which was 4 hours and 1 hour, where we no longer see the distinct characteristics of the trading range that we were talking about, a continuous combination of large overlapping K lines, and this is what we call a tight trading range or an extreme trading range. There is no good way to enter a market that is either high or low, or you wait until it is clearly broken. We found that the same market state and the same shape, it in different time periods to see the chart is quite different. You can also feel the market state under different cycles. It is very helpful for you to understand the price movement. So the question is, should we put a structure on a chart with 50 or 60 K lines, or should we put a chart with 100 or 200 K lines? And there's really no right answer to that question depending on what kind of entry you prefer. Like I do, people who like to look at price behavior and who use signal K lines to enter the market naturally have fewer K lines to analyze. For example, when I trade myself, there are no more than 200 K lines on the chart. Some people like to use the form to enter the market. For example, if he predicts a support level and does not enter the market until he sees a double bottom of the support level, this trader will naturally have more K lines on the chart because he is more concerned with the form and less concerned with the micro price behavior. If you learn price behavior trading from me, you must pay attention not to look for signals in the large period structure. After the trading fails, you still ask me why the signals are not working well, which makes it difficult for me to answer. One last thing before we get into the teaching of range trading is whether a pause in the price of a range break represents a success or a failure of a range break. We can never know in advance, no matter what indicator you use or how you judge a range break. It's the same. The indicators that filter a range break have a very strong lag. Some people say use volume to judge a break. And if you look at it a lot, you can see that it doesn't work very well and it's more of an afterthought. So we do a range break failure trade based on whether it's weak at the time of the break and there's no follow through, and as soon as there's a sign of weakness, we think it's a breakout failure. If the market signals weakness before it breaks out, then our breakout failure signal has failed, meaning it's a failure of a range breakout failure, which is a breakout pullback. And again, as I'll say every time I talk about ranges, you only know in hindsight whether an interval is broken or not. This is the conclusion of the trading masters who have studied more than 100,000 charts, and we mere mortals don't want to challenge it. We can only make decisions during the session based on the signals that come up, and once the market says no, we cut our losses and don't fight the market. Why I'm going to talk so much before I start teaching, and some people might even think it's nonsense because you're going to do a trade and you're going to do a technical analysis, and it's a very logical thing to do. And if your underlying logic is incomplete or even wrong, then it's going to be hard for you to learn anything, and don't even think you're going to make money trading. what I've talked about so far, and I'm going to do all the videos in the future, but all of these things add up to nothing compared to what I've learned about trading. And if you want to make steady profits through trading, and you want to be one of the few good people in the market, you have to be good at learning and summarizing and not being lazy. Next, I will explain the trading case of the interval. In fact, it is very troublesome to prepare the case of the interval, because most of the intervals in the market are very complicated. Both the structure of the interval and the movement within the interval are relatively complicated. When I was trading by myself, I didn't care about making any drawing because you gave me any drawing, but it was a big challenge for me to explain such a complex case involving so many knowledge points to everyone. I've got two relatively simple ones in this video, and if I can't find the easy ones in the next video, I'm going to have to try and explain the more complicated ones. So I hope you'll listen carefully, and if you don't understand, then listen to them a couple of times, because there's nothing you can do. As I said in the last video, the standard trading band, the simple trading band, is really rare in the market, and you can go back and see why. Because of the movement of the interval, it represents a kind of uncertainty in the direction of the market, and that itself is complicated, and it's uncertain, right? So it's naturally complicated. The old way is we get a chart and we look at the state of the market, and we look at a trend down, rapid sideways adjustment, and then rapid down, and then a down channel, and then a fast channel, and then a deep upward correction. Because this video is about ranges and other trading opportunities, and I'll go through them briefly. In fact, there's a very simple short signal, and if you're listening to me from the beginning, it's very easy to see. Let's take a look at the previous verification and verify that the points that it breaks include the signal K line, including a fake double up break, which is a very nice little short K line. I'm not going to say much about that. The big market background is a downtrend, and a trend is very difficult to change. There was a deep uptrend correction, and then the market tested the peak of the trend with high probability. That's a basic law of market movement. From here on, after the price fell, we found that the market didn't test the trend in time. He made a fake break out of the previous low, and the market is hesitating here. All this uptick or this range, however you want to interpret it, is very ambiguous, and we can see that there are a lot of overlapping K lines, a lot of non-trend K lines. This combination of K lines, the state of the market, it tells us one thing, is that the market is in a very uncertain state, and if the market is uncertain, what is it going to bring? It can lead to a false breakout. Because it's uncertain, you can easily lead to a real breakout in a certain market, like a strong trend, and now when the market is uncertain, you can lead to a false breakout. Let's look at the price making a false breakout at a point in the band where the extreme value of the front hedral line is a signal that the K line is quite obvious. After the fake break, the price fell sharply. This period of bearish trend K line is more than the entity is more long light. From the performance of the K line, it is stronger. It's a little harder. It's obvious in hindsight that it was a false break from the extreme of this lead, but what we would do in the actual trade is to make a support resistance based on a lead this long, and it shouldn't be. Most of the time it doesn't. Let's look at this sharp drop, and it makes a false break to the front band low, and see if we can verify that the break is still a long way off. It's not bad for the K line, which doesn't produce a positive line, but it does have a long positive line, and it makes a false break to the front band. Whether this K line can be used as a long entry signal, K line can be no problem, but such a rapid decline and wait for a second entry opportunity to pass better. Anyway, it depends on your personal style of trading, and I wouldn't do it if you gave it to me, because if it was a single K line inversion, I would like it to be a little bit stronger, but it would be better to take a positive line out and have a little bit less overhead, but the opposite line is fine. If we look at the next move, we see that the first call to go long went up, and that was fine, but then the market overruled it and it went down again, and it broke the low of this K line, and if we come in at the K line, the stop is usually below the K line. So, if you go long and you don't reach your stop, depending on how your stop is set up, then you might be out at break even or out at a stop loss, but it gives us a second chance to go long. Let's see, this is a signal K line in senior year. It's a signal K line, it's not an entry K line. Whether it's ABU's number K line or my usual secondary break, it's a line K line. That's the K line, the arrow points to the K line that's broken, and then the pattern is established. On the top of this K wire it goes straight in, and at this point what we find is this first wire, the K wire, is just making a fake break against the low of the front band, but it gives a second entry signal, and the K wire tests the break point is that it's a better entry signal. Sometimes that's what the market does when it's close to the next support or the next important level, and it's going to deny you a move in front of it to test the next support or resistance that's very close. And that's what happens in the market. So what we see is this second break and this sophomore, this fake break to the previous point verifies the previous break. After this entry, which I didn't talk about, we talked about earlier, was that it was supposed to go down to test the bottom, and it didn't go down, it did a complicated lateral movement here, and the market got blurred, and it was here that we already thought that the market was in a potential trading range because of the blurring, and you have to get a feel for the market. The trading range is the uncertainty of direction, and you've seen and felt the uncertainty of the market while you've been here. And what's the signal that gives you an entry, that gives you a false breakout, that validates your belief that this uncertainty is a potential trading range? The range of the range that we think it's doing is like this, this big. It's not like I'm drawing this small boundary. Let me take this out, that might confuse the audience. We think it's a big trading range, potential, technical word potential. So if you're long here, how do you manage your order book? A lot of people do. Interval is not good at managing their orders. Listen here as I talk about the logic of price movements in an interval. In a trading band, we all know that there is an advantage to being high and low like this trading band, and this trading band, as I said before, is a potential trading band that we know from the previous market movements that it may form a trading band. No, it has formed, and if we are long on the bottom, there is an advantage. There's an advantage if you're short at the top, but does that advantage still exist when the price moves to the middle of the range? Does that probability advantage still exist when the price goes back to the middle of the range when it's a neutral probability state? It might go a little bit one way first, but the probability advantage is very small. Let's say it has a false breakdown now, it tends to go up and test the top, but the probability advantage is very small, and you can't design your system by relying on that little bit of an advantage. So how do we manage the order? Let's say we're long at the bottom of this potential range. If I'm in the middle of the upper range, let's say we're at this level right here, let's mark it a little bit. That's the upper middle, so I'm going to break half, and then I'm going to get the other half, and that's the top of the range. And why is that? Because the middle of the range is the point where we have the greatest advantage. We got long at the bottom, and the price is going to quickly move back to the middle of the range, and that's a probability point where the market has the greatest advantage. When the price goes back to the middle of the class, the probability advantage goes down, and it goes back up and down 55. Why can we hold the other half of the position? And the other half of the position is the break-even ratio, because we came in early and the stop loss is down here, so we've got the profit advantage, and now the probability of going up is 55. So at this point, if you think about your profit/loss ratio to the remaining 50, it doesn't matter if even though you have a win ratio of 50, you have a high profit/loss ratio, you are statistically advantager, and you can still take a gamble with the remaining half of your position. And someone said, well, can I gamble the whole thing, which is to get to the top of the range? And that's mathematically okay, and mathematically there's no problem with that. But it's going to hurt you a lot, which is if the price goes to the middle of the range, let's say it's a high probability that the target is met and you don't even break half of it and you hold on to it. What if the price keeps going down? The range is going to fail and it's going to knock out your stop loss, and it's a high probability that your profit is gone. And that actually has a big effect on your mentality, so I don't really recommend doing that. If you say the price goes back to the middle of the range and you stop in half the rest. If we look at the subsequent market action simply going up, easily reaching the stop margin, there's nothing to say about this. There's nothing to say about any successful trade. The important thing is the logic behind the trade. We were judging the market before it was potentially forming a trading range, and now that the price has moved to the top of the range, can we short it? Look for the entry pattern, and there's already a secondary breakout signal, and the short break has been established, and the breakout has two lower lows. If you don't know what the secondary breakout entry pattern is, and you look at the technical pattern of the K line in my previous lectures, there are still a lot of people who don't know how the secondary breakout looks and counts. so I can only suggest that you read it carefully because I've talked about it in great detail and I've talked about it many times in my previous lectures. I can't go through it in every lecture because it's a waste of time. Is there a problem with the entry of the second break? It's logically okay because it's at the top of the interval, but I personally prefer it to have a false break. Let's say you make a fake break here for the front band point and then you do it, but here it's logically okay for you to enter here. We're going to look at what happens next, and this is really bad because the next K line is your entry K line. Look at the second arrow that comes in, and then the market takes a cross, and then it takes a cross horizontally. That's when you have to manage your order. Why? Because when you go in, you're judging the second break short structure, but in fact the market has gone from the second break structure to a wire mesh structure. Let's look at the continuous non-trend K line with the cross star. If you don't know what a barbed wire pattern is, or if you look at my previous video on the basic K line pattern where I talked about the barbed wire pattern, which represents the extreme trading range, which represents the uncertainty of the market, when you enter the form of this, you'd better be a small loss to leave the field. You like your entry price is also given to you a small loss to leave the field, or you break even to leave the field. Because your entry logic has been denied by the market, I don't know if you can accept it. Suppose you do not have a position now, that means you did not enter the second time to break short. Then what do you do now? If we look at the overall state of the market, it's a potentially large trading band, and on a micro level it's an extremely tight trading band. So at that point you can put a short position on this narrow band because it's a test of size and shape, how the trading range is traded, how high it is, and how low it is. This is never going to change and it's always going to be true, and you're in this narrow band called the range. So let me draw it just a little bit. If you short this narrow range, what's your advantage? And your advantage is the math advantage. The education gap is 50 to 50, so if you short this narrow range, if it breaks down and breaks up and down and it just fits in with the formation of the top of the big regional trading band, then it will test the lower part of the trading band and your win ratio will be 50% and your profit/loss ratio will probably go down to 2, maybe down to 3, and you will have a mathematical advantage. Remember, this is a data advantage, this is not your direction judgment, that's all it is. A clever friend might ask at this point, if it is a mathematical advantage to place a short order at the top, can I place a long order at the bottom? Since the probability of breaking through this narrow range is 50:50 for the College of Education, if I break through this narrow range, I will break through the wide range. There is no problem. This is what I emphasized in the middle of the video at the very beginning. When the price is at the top and bottom of the range or at the break, whether it's a break failure or a break success, you don't know in advance. No one can tell, no credit can tell. If someone tells you they can tell, most of the time they're lying to you or they don't know. If someone can really tell a break in the interval, just tell a break in the break run. If he has this ability, you'll see his name on World Money. In less than 20 years, it's an amazing ability. If you look at the subsequent market trend, the short orders in the front should have all stopped losses. No matter what logic you use to enter the market, even if you put your order at the top of the narrow circle in the back, the increase is also very high. It should be to beat the stop loss. But we see that even though you have stopped the range and still haven't broken out of the upside, this time to watch the future market trend to give new trading opportunities. Let's look at this K line. This K line, it breaks both the top of our tight trading range and the top of our front band, but it creates a false break, and this K line appears again. That's the phrase. A break is a weak break, is a break that has no follow through, and this break is a failure. We're going to find the opportunity to go short, and I'm going to mention that if you fail the first time, do you want to make a second time? If you make a second time, if you make the same kind of move. But I personally don't do it. Why? I've shared in the group that my personal weakness is, what's the weakness of the trading channel, is that it's easy to go to the top. If you say a shape like this, and I stop my first short and I do it a second time, give me the shape and I do it, and if I stop my second time, give me the shape and the shape doesn't break, and if I give me the logical position to go short and I do it a third time, it's very easy for me to go to the top and I can't control it. That's what I know about my weaknesses, so I put a limit on myself is that I have one form and I only do it once, and I only do it once, the most conservative one, like why a lot of times I don't do it the first time, because it's not strong enough. I only do the very strong, very conservative form, and I only do it once, and if I lose this time I'll talk about it later. Now I don't do it, of course. This is my personal trading style or trading discipline. Everyone's psychological state is different. Maybe some people can rational continuous trading, that is amazing. I am not able to do. Everyone measure their level. Take a look at this long shadow line to confirm the failure of the breakthrough, to confirm the above selling order selling pressure, then this time can directly short. It's not recommended because the K line is too long, like the signal K line is too long, you just stop too far. For example, if you go in here and short, you just short instead of breaking out, you're more than 50 points too far. So, if you have a long K line like this, you put your order in the middle of the K line or above the K line, and then you put your order up, and then you have to stop your loss. What's the advantage of that is that if you take the same conversion and you both put 50 points and you recommend the middle order and you put another 50 points. Right, then you're being very conservative and you're just going to short here, you put in 50 points, and then you might lose the last time the price broke, and this is very painful. If we look at the K lines behind the signal K line, it becomes again the same kind of horizontal continuous overlapping long non-trend. K line is again going through a narrow band, and the state of the school of education is very uncomfortable, and that's why I get a lot of headaches when I go to Amway, because that's what happens in most cases. It's a complex state of motion. It's hard for me to talk about it and it's hard for you to listen to it, but there's no way that a lot of times in the market the movement is like this, and the clear entry signals, like here, the clear entry signals are few and far between given to you, and you better take advantage of it. Most of the time it's like this, it's all messed up and looks like it doesn't know what it's doing. So if the price is here and it trades in a tight range, then it's going to have a 50/50 chance of going up and down again. But because we talked about at the beginning, we did the range break. Failure is the subjective view. He was bearish, and when you have this kind of ambiguity, a lot of times you're going to have to trade subjective, or you're not going to trade subjective if you do. So, if I'm subjectively bearish and we're on the top and we're short, or if you're subjectively long and you're on the bottom and you're long, there's a mathematical advantage, and your advantage is not your advantage in reading graphs, it's a mathematical advantage, and you have to keep that in mind. If you look at the subsequent market trend and the market chooses to break down, then it follows the formation of a large range, which is very simple, and I won't mention that again. It's not important what I said about the successful trade. It's important to go back and listen to the logic if you don't understand the logic that you just heard. Let's see if we're given an entry pattern for this interval, and this part of the interval is not operable. So just a quick note here, if a large interval is formed, what signal is it giving you in the middle of the interval? And the K line is best not to do it, because it's probably a failure. The move up and down the middle of the interval is 50/50 up and down. The middle of the interval is the most chaotic state, so don't get involved in it. The price here is very high. At the bottom of the range, can we find an entry signal? If you look at the big negative line in the front, and I don't know if I've talked about this in the video, actually I talk about this all the time in the group, the big positive line in the interval, the big negative line is meaningless like this negative line. If you mark it like this negative line, a lot of people look at this negative line and they say, wow, shorts are so strong, go short. This is totally wrong. Why we talk about the interval you are to high low? Well, then since the emergence of this bigging line directly hit the bottom of the interval, what do you want to do is what the main see this bigging line must be to do more, because to the bottom of the last year, how can you see a bigging line? Think that the bear strong, right? The big shadow line is followed by a shadow line with a long shadow line. Again, if it's the first entry signal, the K line is not strong enough, I don't want to participate. But this is not the K line either. It's just a proof of support. This negative line, even though it's a negative line, it has a high lift. It's the first upward breakout, and at this point we're waiting for a second upward breakout, so it becomes a multiplex form of a second upward breakout, and this is very simple, and you can look at it, but this again doesn't have a false breakout to the premise. At this point your win rate is going to go down a little bit, but you still have no problem with your logic. There's no problem, there's still a very strong entry format. the bottom of the range, and you have no problem doing it, just saying it's better to have a fake break. So let's look at what's going on, because we've been talking for a long time, and I'm just going to put all the K lines in the back, and I'm not going to go through them step by step, but let's look at the K line where we were at the first time when we were at the K line, and we said we're going to be a senior in high school, and then the K line is going to appear, but it's going to appear and it's going to go up. If you're not prepared, if you don't anticipate that this is going to happen and you don't prepare for it, then you're probably not going to catch it. That's one of the disadvantages of doing price action trading, is that you need to be aware that you have to read the chart very quickly, because the main thing that we're going to do is, if you're going to do short trading, if you're going to do band trading, and I'm going to share a band trading system in the future, and I used it a long time ago, and I do more short trading now, because in the short term you make money every single day. That's not quite right, you make money every single day on average, and sometimes you lose money. We see this as the second breakout to the upside, and it goes straight to the upside, and it stops comfortably. That's what I was talking about earlier. That's why we're going to even out half in the middle of the class. You see here, you see, if you go long this time you're not at the top of the range, but you've come this far, and the middle of the range is the highest probability target, and you're halfway there, and you've got a very good break-even ratio. Let's see if you break short here, and your stop is, let's say, 30 points, 30 plus, then your profit is already close to 90 points, and that's a 3-to-1 break even for my short trade, which is very high, and that's good enough. One more thing we just talked about is that the big negative line is so long, it doesn't make any sense, and the big positive line is the same thing, right? Right? So you have this long positive line in the interval, and it goes all the way to the middle of the interval, and you say you see this positive line and you get involved. Is that not a good idea? Right? If you look at the back, there seems to be a potential short trading opportunity here. Well, I'm not suggesting that we're in the middle of the range, but there's actually a discovery that has clearly validated the band points twice and then connected them to a horizontal line. That line is simple, clear, single K line reversal, and then a second break. That's pretty easy to do. I'm not going to say that, but it's hard to get in here, and it's hard to get in here, and it's hard to get in here, and it's hard to get in here. We're talking a lot about the entry of the boundary of the interval, and by the way, here you see that the price again moves in this motion of the great negative line to the bottom of the interval, and in most cases the majority of the interval is meaningless, and sometimes it's very rare that this kind of big K line breaks through, but it's very rare that you have to take a look at it yourself. It's a K line that runs out of energy very easily, and it's moving very fast towards the bottom of the interval, and then you have 3 non-trend K lines, which is basically a smaller interval. That positive line, let me mark that positive line, that's pretty strong, and that positive line that closes above the previous K line, that's your signal to come in, and the only doubt is where you put your stop loss, and I don't mean doubt is controversial. Normally our stop is just below the signal K line like this, but we also found that this stop is too close to the previous constant point. Can we beat the price? We can stop and move up, it's okay, but in this case you have to take your stop a little bit wider and put it below the band so it's safer. But it's a matter of choice. Some people are saying you play here and I play here, and if it gives you a chance to move in, if you trade like that, then it doesn't matter, you put it in, you should put a stop loss, and that's okay. So let's look at what's going on here, where we've given the signal and the price is the same when we go long, and it's going to move quickly to the middle of the circle, and this is the first stop that we're talking about, and you should pay more attention to it, and you see it in the middle of the day. It hasn't gone up since midday, and if you're still trying to get him to go up, then it's probably a profit taking or a stop loss, which is a bit of a pain. After that the range was broken, and it's been a very long run. We see that if you're in it and you don't have to look at the signal K line, you're much lower up, then you've made a lot of trades, and on this one you lose, and it's very normal that the range will always break out, and even though it's maintained it tends to stay where it is. It always has a breakout day, and the trend is that even though the trend tends to continue, there's always a reversal day. But the novice trader is better off on the side of the market that has the advantage, and that's you play the trend less, and you play the inversion less, and you play the breakout less. Right, you have to play the probability advantage, and you make the easy money, and you have to play the reversal, you have to play the breakout, which is the breakout of the range, and it's harder to play, or the reversal of the trend, even though there's a mathematical advantage to playing the low probability trade, but a string of stops or low win rates, is very difficult for a novice to swallow. So let's go back to this case, and the point is, how did we figure out what was going on in the front and how did we figure out what was going on in the back? Think about the big downtrend and the deep pullback. The market tends to be at the peak of the pullback trend, but this test doesn't go very long before it stops, and then does this kind of lateral overlap of this trading band, and the market gets into this state of uncertainty, and that's when we think the market is potentially trading in a trading band. We're looking for the signal K line. We can look for the up false break K line. How do I say it here? Let me label it this way. Let's say that the back K line doesn't come out. It goes here, so we can look for the up false break K line, and we can look for the down false break K line, but in our case it's a down break. The logic of interval formation is something that you have to carefully understand. Again, the case that I talked about in the last video, the formation of the school of education, is very standard, very rare. If you have the state of the last video, is very simple, and if you have listened to my course for a long time you should be able to trade. But most of the time markets don't give that kind of shape like this, and if you're not very experienced you might not be able to judge the formation of this potential trading range, and you might miss the opportunity, and you might take it. What about the next couple of entries? The first entry is you need to be experienced, the second entry is very simple, and it doesn't need to be said much more. So if you look at it a little bit, you don't think I'm going to be able to stop the K line, because when I read the K line you can read a lot of information as a price behavior trader. I'm going to tell you what's on my mind, and I'm going to ask you to do what I do to read the K line, so I can't stop talking about this case for about 20 minutes or so the next case we're going to have to put in the next video. And thank you for watching, and I haven't updated much lately because there's a lot of trouble in real life. Right then I had dinner with my family in the Mid-Autumn Festival, so I haven't updated it recently. If I return to normal in the future, there will still be a lot of people urging me to do it twice a week. I didn't expect that so many people are willing to use their brains to learn technical analysis, which is very good. I'm making videos and it's really hard to be more efficient because I have to make my own transactions, and then because I'm making instructional videos and reconciliation videos, it's just different, and you give me a picture and I can talk about it for a long time. But the teaching video is I want to clarify this logic so that you can learn from the easy to the deep. Understand this is more trouble I need to prepare for a long time, is how to put my think of logic to explain to you clearly. Okay, that is all for today. Please consider like, comment and subscribe, plus don't forget to follow my YouTube so that you can watch the follow-up update content.